I'm here with Zach Strickland. Zach, good morning.
Good morning, Andrew Cox. So I've got our tender rejection index paired with our outbound tender volume index for the United States, just for a starting point of reference here. We've got a little bit of an uptick in demand now. Me and Mike Vincent talked about this yesterday. A little bit of a downward trend in the rejection index, also in the demand side index, but the trend for the demand still high. Like, it's still coming up into the holiday. We thought maybe we'd see this little, this notch that might be like, oh wait, things aren't going to be as tight as we thought they were going to be. But no, this looks like, in the longer run, once we push this out a little bit, we're still going to have a tight Labor Day weekend, more than likely. 22.34% on the tender rejection index, slightly higher today versus yesterday. So it's probably going to continue to increase the closer we get to the Labor Day weekend. Demand still extremely strong. Long haul volumes are actually growing right now. So there you have it. The nation is probably going to get Labor Day as expected. What was unusual, though, and what we didn't really expect to see if you looked at historical trends, was this uptick before Labor Day weekend.
Right.
And this is really where the anomaly is. It's not necessarily right here.
It's important to remember here that we're talking about daily data, and we do it on a daily basis.
Exactly.
So it's hard to build trends out of this, but the trend here is definitely intact. Volumes are headed higher, and rejections have really bounced off the bottom in early August.
Exactly. So let's go ahead and take a look at the next chart that I want to show. I showed you this last week. So this is our contract data. This is our $80 billion worth of invoices for van contract rates, and we can see a nice little trend line here. And this is the truck stop top 100 spot market rates, and the purple line here. And the point I made last week with this was, this white line is an estimated fuel surcharge that you would have to add on to these contract rates, because these up here, they're all in. They include fuel. So to make this a true apples to apples comparison, you really need to have fuel included in the contract rates. Now, this is just an estimation over something that I've done, off of a fuel surcharge that I've had and used for years. It doesn't apply to everyone, but it is a pretty good generic way to just set up where the fuel boundary is, because fuel rose 30 to 40% since November. And so this line represents the margin, or the spread, that the spot market has over the contract market.
Right.
And brokers, typically will charge, a percentage higher than what they would normally get on the contract, because that's their transfer, that's their fees. That's how they make money. And you can see that the contract rates rose so quickly, and fuel costs rose so quickly, that it compressed the margins. So we had about a 11 to 17% right around Christmas. Of course, that's the biggest spread that you're going to see. Into last year, this year it's 6-7%. And so they're going to try to make that up, because their targets are still going to be the same targets that they were back here. Now, what's interesting, and why I brought this up back this week, is the contract rates really have plateaued, and we're not seeing as much upward movement or upward pressure. So it's going to give them time to kind of catch up and push these rates higher, for a bit. But the contract rates are not moving any higher at this point.
Yeah, this is something that we've written about in the pricing power index. I think it's about 4 or 5 times now we've just hit that 260 per mile, and it's just been a buffer, ceiling for the industry.
Yeah, and we took these stair steps, in just about every month, starting in about February, where you could see these contract rate increases, or, perceived contract rate increases. There's obviously variances in, lengths of haul and different, lanes having more weight or whatever, but the overall trend is pretty much the same until you get about to June. Starting in June of last year, we really had a huge uptick there. And then it just kind of stops and stalls out here. So what'll be interesting to see is the next couple of weeks of the spot rates, to see if they do start to expand their margins, continue to expand the margins, especially as service becomes more of an issue, because the word on the street is that this $2.58, $2.60 isn't really getting a lot of the service. We looked at the rejection rate at 22.2%. It's still not good.
No.
So there's still plenty of room up here, for people to go to the spot market.
Yeah, demand is unwavering and rejection rates stay really high. We've definitely got some pressure upwards on spot rates over the next couple of weeks. Zach, thank you so much.